Well, this week, we're going to talk about some of the top performers on the S&P 500 last year. So 2015 calendar year, which did the best on the S&P 500. And I'm going to give you right away the punchline. I'm going to give you the top performers, the gold, silver, and bronze award winners for last year's performance. And they are number one, the top performer on the S&P 500. Again, 500 of the largest companies in America, a list managed by the publishing company Standard & Poor's, the S&P 500. The number one performer was Netflix. Netflix was up 139.2% last year, leading all of those big companies in stock performance. Number two last year was Amazon. Amazon was up 122%. CEO Jeff Bezos once again driving huge value creation. And the number three performer last year was Activision Blizzard. That's the pure play online gaming stock, the video game company, up 95.7%. Now, why am I talking about these? Well, on a quick side note, these are three of our biggest stocks. These are three recommendations from my Motley Fool Stock Advisor service. We've had them for years. So I'm partly just briefly bragging that we had in that one service numbers 1, 2, and 3. I was doing the math. We have 26 stocks in Stock Advisor. On my side, my brother has the other half of that service. On my side of the scorecard, we have 26 of the 500 S&P 500 stocks. So we have a small minority. And so it is, I think, more than just luck that we would have numbers 1, 2, and 3. That said, I want to mention right away, there is a lot of luck in any 1 year of the market. You can look really silly good or silly bad and not deserve it in either case. So it isn't so much my point to point out that we've had those three, but to actually look for some similarities among those three. If you've ever played a game where you sit there with others and try to dream up as many things as you can in 60 seconds or so, that's kind of what this podcast is. I'll spend a little bit more than 60 seconds, but I'm just going to try to dream up and come up with as many similarities among those three so that we can extract from those similarities maybe some core traits or lessons that we want to learn as investors from what worked last year. I do want to mention before we start our list that it was just 1 year. It was last year. In fact, it's a little bittersweet because I'm taping this podcast on the 19th, Tuesday, April 19th, and Netflix is down about 11 or 12% today in just 1 day. So, one of my favorite stocks, one of our biggest holdings at the Motley Fool, had earnings that looked good but didn't quite please the market enough for at least 1 day. So it's a little bit bittersweet for me to talk about Netflix, ironically, on this particular day, but I'm not shy about that. So with that said, here are some traits that I can see that run through these three companies. And by the way, I'd love to hear from you. So on Twitter this week, if you like, at RBI Podcast, let me know any additional similarities, maybe some nuances, some subtleties that I'm bluntly going to miss that you see that can help us as investors, some traits that these companies share. So the first one I want to mention as I start my list is entertainment. Every one of these is in the entertainment business. Certainly, Netflix is really in command, I think, worldwide. It's by no means a dominant market share. We're talking about a very spread out market, but there's no clearer worldwide leader when it comes to movies and television shows than Netflix and where it is today. Similarly, Activision Blizzard with its properties, World of Warcraft. By the way, Warcraft is going to be a movie this summer in the theaters. It'll be interesting to see how that does. Call of Duty, Hearthstone more recently, lots of different entertainment properties. And then, of course, Amazon.com not only sells all of these products, but also contributes its own with Amazon Video, which you can use if you are an Amazon Prime member. And Amazon is investing a lot these days, as is Netflix, in the core creation of new entertainment. So the first thing that we see, that I see as I think about these three companies, is they're in what I consider to be an outstanding, timeless industry. Entertainment. The second similarity shared by all of these three is that they are content producers. They're not just in the entertainment business. They are actively creating content, whether it's Netflix, having funded everything from big shows like House of Cards or much smaller, sometimes just one-off comedies with popular comics. But Netflix is clearly producing content. It wasn't always that way. It's only relatively recently that Netflix has even entered that market. Similarly, we know Amazon is doing the same thing, and then Activision Blizzard all the time is creating new video games. So number two, within a great industry, they are producers. They are content owners. The work that these companies are doing is building up an archived library of properties. A third similarity shared by all three of these is that they are branded properties. You recognize names like House of Cards for Netflix or Call of Duty when it comes to video games for Activision Blizzard. And so this is a really important thing. It's not just that you own content, it's that it's branded content that can work across transmedia. You know, one of the big trends that we've seen in the last 15 or 20 years, think of Marvel with its superheroes, think of The Lord of the Rings, is we've seen properties that started in one medium, comic books, all of a sudden go into other media. Transmedia, across media, everything from movies to lunchboxes and lots of stuff in between. And that's the power of having branded properties, which is what all three of these companies, frankly, have and are continuing to develop. So that's an important third similarity. Here's a fourth one. All three of these companies are making lots of bets. So it's not just about a single big biotech drug and that biotech stock hanging on whether it gets FDA approval or not. These are not binary outcome companies. These are companies that are experienced taking risks, but they're doing it across a wide array of possibilities. And yes, some of Amazon's risks haven't worked out so well. For example, the Amazon phone, was it the Fire phone? I've almost already forgotten about it, but that didn't do so well. And certainly there are some clunkers out there. Ironically, for Netflix, The Ridiculous Six, which has gotten ridiculously bad ratings, is also the #1 most watched movie in the history of Netflix. So things arguably, I don't know if we say that worked or did not. I guess we'd say it worked overall, but every one of these companies has had failures, will have failures in future, but the beauty of it is you're invested in companies that when they fail, they can rebound from that. They're not betting it all on black. Similarity number 5. Not only do these companies operate in the entertainment business as content producers of branded properties that make lots of bets, but I want to take that one notch further. I'm going to say that these companies do a darn good job with that. In other words, they bring joy to the lives of many. Whether you are a World of Warcraft longtime player or somebody who just enjoys being able to watch 24, all 9 seasons or whatever it is, binging on whatever you've watched in the last week or so, these companies, I think, they're certainly enhancing my life. I hope at least one of them is enhancing your life. And we love these businesses, and this runs up and down stocks that I pick in Rule Breakers and Stock Advisor, but especially the best ones. After all, here we are this week talking about the top 3 performers on the S&P 500 last year, and all of them do a really nice job bringing joy to the lives of many. And I think that's important to point out. Sometimes investing doesn't need to be that much more complicated than asking yourself, who's bringing value to the world out there? Who is adding value to your life? And then beyond the sample size of one that each of us represents, who is bringing joy to the lives of many? It's a fairly simple filter. It doesn't take a CFA or training in accounting or your ability to read financial statements. I do think that those things are valuable as well, but you can increase your own odds an awful lot by focusing on where real value is being added in the world. Okay, I'm going to start losing my math here. I think that was 5. So next we're going to go with 6. My list is going to start running out, by the way. This will be one of our shorter podcasts this week. But number 6, all 3 of these companies are some combination of software companies or operate in the cloud. And that is itself a really important realization, because companies that are more software-oriented or more cloud-oriented basically are lighter business models, and we favor these a lot as well in the services that I pick stocks for and with my analysts. We like companies that don't have to invest a huge amount in heavy industry. They don't have to pay for everything that an airplane entails in order to get a plane flying up and making profits for the business. Heavier industries like, well, airplanes, cars, etc., where there's a huge amount of cost in order to get even a single product out there that somebody would buy. While there can be some very powerful models there, and Southwest Airlines has been a great long-term stock performer, the reality is that these lighter business models, think about Amazon and what it's doing with the cloud. I mean, it is actually enabling a lot of Netflix to happen through Amazon Web Services. But Amazon is not only a cloud user, but it's also a cloud purveyor. It sells cloud services to so many companies. I think probably the Motley Fool included, all benefiting from its servers running your website. So that's kind of the cloud business, but you can also see that software business clearly running through its video games. Activision Blizzard has many people who are kind of subscribed, who are regularly using its product, and I'm going to bleed this over right into number 7. So from software and cloud, number 7 is that all three of these companies have subscription businesses. Maybe my favorite business model. You and I, as consumers, put up the cash up front. We buy ahead of time that service, Netflix for the month ahead, or World of Warcraft for the year ahead. Whatever it is, we are paying up front and creating recurring relationships with the companies we're doing business with. Yes, a lot of companies, the Motley Fool included, auto-rebill you from 1 month or year to the next. And while anybody can cancel at any time, and that's true of most good businesses in this space, the reality is that most of us, unless we're highly displeased by the service, we will continue with that service and make it a regular, recurring part of our life. And you can clearly see it in Netflix and Amazon and Activision Blizzard. So appreciate that about these businesses as well, which takes me finally to numbers 8 and 9. And both of these aren't so much about the companies, but about how the Motley Fool has covered them and how we've treated them over the years. Number 8, all three of them are multiple recommendations in Motley Fool Stock Advisor. So it's not just that we picked the stock once back in 2002 and have held ever since. It is, in fact, that we did pick Amazon in 2002 for Stock Advisor or Netflix in 2004, but it's that we've continued adding to that stock over the course of time. Netflix has been recommended 4 additional times since we first picked it. Activision Blizzard, I first picked in August of 2002. Similarly, I've added to it 3 separate times since. And finally, Amazon.com is probably the single stock that I've held the longest, predating Stock Advisor to when we had it. For those who remember the Motley Fool back in the AOL days, when we first launched our service, we had it in our original portfolio, which we called the Fool portfolio at the time, and then later rebranded to the Rule Breaker portfolio. This is all before Motley Fool Stock Advisor. We bought Amazon in 1997, but we've added several times since. And so that's really important. It's important for us as investors, I think, to find what's working and add to that over time. Too many of us think about just adding to something that's down or trying to get back to even with a loser by lowering our cost basis. And we've talked about this on this podcast. That can work in some situations, and brave people do that all the time. But in my experience, you're better off more often than not, if you have new money, putting it towards something that's working, towards something that's winning. And so with Motley Fool Stock Advisor and these 3 stocks, how we've treated them is that we have added to them consistently over the course of time. That doesn't even include the many times they've been named as Best Buys Now, which is a key feature of all Motley Fool services, but they've been frequent recurring companies there. And number 9, similarly, and this is important, everyone has to remember this, especially on a day, today when I tape this, that Netflix has dropped more than 10% in a single day. All 3 of these companies you had to hold well up and down over the course of time to really make the profits that you enjoyed in 2015. Netflix, the big Quickster fiasco, after 2010 is a great example of that. Netflix has been a very difficult stock to have held for a long time, as has Amazon.com. When we first bought it, our cost basis was $3.21 in 1997. It went to $95 over the course of the next 4 years. It then dropped from $95 to $7, and we continued to hold. And these days, I'm happy to say it's much closer to, well, it's over 600. So we've been well rewarded, but along the way, there have been many and will be many drops for these kinds of companies, more volatile stocks. And I said there were going to be 9 similarities, but I found a 10th. I'm just going to mention it as well. And that is, and maybe it's already become clear, we've held each of these for a long time, which causes me to close out this week's podcast with a brief meditation on FANG. Do you know FANG? Well, Fang can mean many things. For example, Fang was a pet of Hagrid in the Harry Potter series. I didn't remember that. Fang is the Arizona Rattlers mascot. It's a man on a motorcycle. Fang is just the snake's poison-injecting tooth. I think we all know that version. Hope to never get too close to it. It's a town in Thailand. The list goes on. But for a lot of investors, they think of the acronym FANG, 4 big-time stocks in recent years: Facebook, Amazon, Netflix, and Google. And these companies are regularly referred to as kind of a 4 horsemen by some people, or a group of stocks, kind of must-have stocks that you've had to have, and having them start with those 4 letters and being able to arrange them in that way gives them a little cachet when you're able to talk about FANG. It's not an acronym that I use very often, and in fact, my closing meditation is beware of this kind of thinking. Often what happens is after stocks have made a big run, someone invents a catchy phrase, or in this case, acronym, and while I love each of those companies, and we've held those companies for many years, I encourage you to generally eschew these kinds of terms, this cachet, because what they're representing for you is stocks that have already probably moved significantly within the last year or two. It isn't to say that they're not going to have a great next year or two, and for each of those, I think they'll have a great next 5 years or so, but don't get caught up or swept up in the acronymizing of small baskets of superhero stocks. At the very same time that I ask you to watch out for those, I'll also ask you your FANG score, and we'll close with that this week. What is your FANG score? Your FANG score is simply if you add up the number of years that you've held each of those 4 companies. If you own any of Facebook, Amazon, Netflix, or Google, which is today Alphabet, so the acronym's starting to break down. I think I have those 4 right. I might even not have those 4 right. It might be a different G, but I think it's Google. Anyway, what is your FANG score? You take the number of years you've held any of those stocks, and you simply sum it up. And I submit to you that most of the people who use FANG or talk about FANG don't have a very big FANG score. And I think it's because people tend to chase whatever the latest winner was. It happens in the mutual fund industry all the time. It's called window dressing, when fund managers in the last day of a quarter or last week of a year add certain stocks to their fund so they can show that name and say, yes, we had that stock in our fund too. Very superficial window dressing. So I think a lot of the FANG talkers and FANG scorers don't have the number that I hope you have. I'll give you my FANG score. It's just the Stock Advisor and Rule Breakers FANG score, and it's 34. So 34 if you add up those 4 stocks. Anything over 10, give yourself a golden star. Anything below 10, I still think you found a good thing, but if your FANG score is more like 1 or 2, you're either somebody who's just brand new to the Motley Fool, which I hope is the case, and I hope you own those companies for the long term, or you might be somebody tending to chase last year's big winner.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about rule breaker investing at rbi.fool.com.